Capital structure. Why is capital structure important? The capital structure is important because we need to know our level of gearing, our leverage level. We need to know the level of gearing, and then as such, we know our level of gearing. It will help us to determine if we are exposed to high finance risk or not, and how should we reduce. And note something about debt and equity. Debt is actually cheaper than equity. Debt, debt, sorry, debt is sweet. Debt is sweet. Why? Because it is cheaper than equity. Remember, how is it cheaper than equity? Because debt instrument, we pay a fixed amount of interest on it. But if it is equity, by the time we pay tax, they will share the profit of the company with us. And so we only see that is cheap. So, and then to some extent, to a large extent, we always consider that if we want to raise anything, all right, there is a need for us to consider debt rather than equity. So going on, we want to look at, since I have said the reason for us to know capital structure is number one, to check our gearing level, to know the benefits and costs of debt, or let me not use cost as an opposite, to know the benefits and disadvantages of debt finance. So number one is to know the gearing level, and number two is to know the benefit and disadvantage of debt finance. That is the reason for this capital structure. So we want to know, should we increase debt or reduce it? What is the benefit of debt to the organizational value, right? So in this case, we're going to be looking at the relationship between gearing and costs of capital. So that means it looks at the relationship between gearing, cost of capital, and the value of the company. All right. So these three things are key for capital structure. All right. So the first theory we're going to be looking at that examines the capital structure is Modigliani and Miller. Modigliani and Miller. These guys troubled a lot of people, right? So their analysis concentrates on two types of systematic risk. So they identify two types of risk, or let me call it systematic risk. And what are these systematic risks? We have a business risk and finance risk. Now, these people, by the time we explain, we understand them, we'll now be using them interchangeably with gearing and non-gearing. And that is where we're going to be seeing the relationship between them and gearing. So what is the business risk according to them? They assume that business risk arises out of the risky nature of the area of business. That is how the nature of the business brings about business risk. Okay, why finance risk arises out of how the company finances itself. Okay, so they say that the business risk has to do with the risk inherent in the business, while finance risk looks at how a business finances itself. All right, so that means after paying interest liability, the ability to pay dividend to shareholders is what is known as finance risk. Are we together? So the risk that the shareholders would lose what will come to them after a company pays its finance risk is what we refer to as, after a company pays its interest expense is what is referred to as a finance risk. Are we together, class? So now the next thing is that what is the impact of this on cost of equity? So this Modigliani and Miller, they propounded or they postulated, so we call them M and M. M and M, M and M postulated two um two theories, two assumptions. Let me use that word. One, the world of tax, and two, the world of no tax. All right. So the word of tax and the word of no tax. So like I said, my name postulation has two theories or words. So the first one is word of tax and word of no tax. So the first one they propounded was word of no tax, sorry. So that was the first postulation, word of no tax. So their assumption was that, um, don't forget I said they recognize business risk and finance risk, where they assume that business risk is represented by cost of equity on geared. All right. This is business risk to them. But before I even go further to that, let me explain the word of no tax and the word of tax. In the word of no tax, right, they have some assumptions, and those assumptions I will represent them in graph. In graph. So some of the assumptions are that one, uh, the cost of equity will keep rising, right? The more we keep increasing our gearing. So gearing, uh, the cost of equity will keep rising. Cost of equity we keep rising, the more we keep increasing our gearing. Why? Because there's need to compensate them for business risk. So this area in the graph talks about compensation for business risk. Compensation for business risk. That is this area, what is talking about. This area. So why the um the additional return for finance risk is measured by this angle. So because they assume that um, as long as we keep increasing our gearing, all right, so this represents additional, all right, return for finance risk. Because the more a company invests, the more a company borrows money, borrows debt, the more they expose um, their their shareholders to finance risk. I want to get that class. So and don't forget that the people that bear finance risk is not are not only the shareholders, but also includes the uh the lenders. The lenders. So that means the people, the companies that are lending out money, the banks that are lending out the money would also be careful. And that is why some theory says that there is a benefit, there's an optimal combination of capital structure, and that talks about the traditional um assumption, that traditional model. But we're going to touch the traditional model here, right? So so it says that in a nutshell, if you look at this guy, Modigliani and Miller proposition, M&M proposition assumes that one, um, the company's rate of return on its assets reflects the risky nature of area of business. That's number one, right? So, and that the business risk is unaffected by how the company finance itself. So WACC will remain constant regardless of the level of gearing. That is the assumption. In other words, Modigliani and Miller first proposition says that in their first proposition, the word of no tax, they say that WACC remains constant. WACC remains constant regardless of the level of gearing, and that the cost of debt will also remain constant. The cost of debt, sorry, they also assume that. So this one is WACC remains constant regardless of gearing. Regardless of gearing, WACC remains constant. And then WACC remains constant regardless of the level of gearing. And then the cost of debt, the cost of debt, um, the cost of debt remains constant too. Constant. So they assume that regardless of how much debt you borrow from bank, the one you sell through bond, your cost of debt will not increase. Unrealistic assumption in their first proposition. And that the cost of equity will be increasing. The cost of equity will be increasing because of the fact that you are introducing gearing, and there is need for you to compensate the company's you need to compensate the shareholders, right, for exposing them to finance risk. And then it's now says something about the company value, because don't forget, this topic relates the gearing with two things. It relates the gearing with uh, cost of capital and the value of the company. Very important. The cost of capital here includes cost of equity and WACC, right? So, and then also cost of debt. So that is what gearing talks about here. And then the value of the company, of course, is the value of the geared company. Now, let's now check also what happens to the value of the company according to their first proposition. The value of the company, according to them, they say no matter the debt a company has in its capital structure, it does not change the value of the company. The value remains constant. So value remains constant. In other words, they propounded irrelevant theory. That is why we always refer to them as irrelevant policy. Even when we get to dividend policies, it is still irrelevant. That means they're saying here that the capital structure decision is irrelevant. It doesn't matter how the company is financed, that the company's value does not change and is unaffected. That no matter the debt you borrow to the company, it does not affect the company's value. And that is why they propounded some formula on how to compute the company's the cost of equity geared equals cost of equity ungeared plus debt over equity, cost of equity ungeared minus cost of debt. Is it okay now? Is it okay now?
Yes, sir.
Can you imagine? See life, oh, life of genius. This way. So this one is called compensation. Compensation for for finance risk. Why this guy is compensation for business risk. So now, in case you are asked question to calculate compensation for finance risk, this is what they want you to calculate. But don't worry, we'll look at many instances. We'll look at many instances. So, and we also gear and ungear here, but in another dimension. And I will show you to a point whereby we can use this guy and use gearing formula and we get the same answer in this same topic. I promise you, I'm promising you, you are going to love it. And there is no way you can escape from it, because we are together in this weather. So let's look at the value of a company geared. I'll still leave the variables. Don't worry yourself. So it is value of ungeared plus VDT. Mm, And the way there's no tax, the WACC of a geared company equals the WACC of ungeared. The WACC of ungeared. So let me label this useless formula so that you will not have a headache. So KEG is cost of equity of a geared company. This KEG can also be calculated using CAPM, where is the cost of equity. Forget about that, we put KEG here, it's still cost of equity of a jet company. When you say risk-free plus beta of equity, return on market minus risk-free. Of course, what you're calculating here is also KEG.
Yes, sir.
Okay, of on
Yeah, with
jet.
you.
Okay, sir. On jet company. Okay, so we have debt, which is the value of debt. Matter that did not right, I hope you are seeing this one so that I'll not work twice.
Sorry, sir, I have
Value.
a
Yes.
question.
Yes, ask your question to the half of my kingdom.
Uh-huh. When we say geared company, does that mean company that has debt, or what's the meaning of geared and ungeared that I've been saying since?
It's not that class with us, Mommy Gio. Okay. But we say debt, it means a company that has debt, capital in its capital structure, in its balance sheet. It has debt, whether long-term debt or bond, okay, or commercial papers. Although commercial paper is a short-term debt, we don't respond with that one. Just like the one Dangote, example of commercial paper is the one the Dangote issued recently. Because Dangote wanted to raise money, so he went through, issuing houses, and then those people now link with their clients. He wanted to raise 50 billion for a target of 200 million, and then there's a return of 23% and 25% for 265 days, and 23% for 180 days. So that one is commercial paper. So it's not part of long-term finance. Do you get? So it's not, we don't categorize that one as debt because that one is traded on that money market. Okay. But for capital market is for long term. So we're saying geared, it means that a company that has long-term liability, not commercial paper, in its capital structure. Have I made myself clear? So if a company does not have debt, then we say the company is ungeared. Does that make sense? So the names we use are geared, leverage, finance, risk, and so on. Exactly.
Okay, thank you.
You're welcome, madam. So VU is value of value of ungeared company. Value of ungeared company. That means when we remove debt, what do we have? We have VU. So why VDT? Get this one carefully. Let me use another pen so that present value of future tax savings on debt. So it is not V1 minus 0, it is VDT. That is his own postulation that VDT means the value of a jet company means that the value of a jet plus the present value of future tax savings on debt. That means any amount you can save on debt, you add it to the value of on jet. That will give us the value of a jet company. All right. Oh my goodness. Sorry. I'm talking about the word of no tax. Sorry. The word of no tax, VU equals VG. VG equals VU. So let's assume that I do not see this VDT. Because we're talking about the word of no tax. The word of no tax. Although in exam context, this one is not relevant. It's just relevant for us to explain it, okay? So that you can have a thorough understanding of their nonsense postulation that is causing a dick for you people. All right. As it's causing a dick, as since ICANN has not removed it from their back, we keep teaching you until they remove it and tired of it. Or else, although I know that none of you repeat this class, by God's grace. But whether you like it or not, we still meet it in final. That means we are still together even in final. All right. So I love you too. So let's go. So we have that is that about their useless postulation of word of no tax. Then after they did their nonsense, another set of crazy people came in. They call themselves traditional theory. Traditional theory. These people came with their idiots to do it with their rubbish too. I said, okay, they research, so don't mind these people. So they came with optimal, optimal capital structure. They are saying that Modigliani and Miller propounded irrelevant theory. But we believe that the gearing of a company is relevant to one, its cost, and also to its market value. All right, to its market value. So, excuse me, and they have their advantage. They now say that debt has advantages to them. They believe that debt has advantages and disadvantages. All right, they believe that debt has advantages and disadvantages. So, what are the advantages they highlighted? According to them, the value of debt is that debt is sweet. They say no, debt is sweet because the cost of debt is less less than cost of equity. All right, so because debt is low risk, all right, because debt is low risk, so they believe that the cost of debt is cheaper, so debt is sweet. All right, for some of you now, if you owe anybody, you be afraid, you be panicking. But this, there's a debt is sweet. You can go on and borrow money from fair money and so on. But be careful, because that's not the kind of debt they're talking about. So, because number two, there is tax relief on interest. There's tax relief on interest, according to them. So, disadvantages. These are the two advantages. And then disadvantages. Disadvantages. So, these advantages is saying that, okay, um, in as much as debt is sweet and it is cheaper, all right. So there's tendency that the uh, uh, it is possible that um, the cost of debt may rise at optimal level. Hence, the cost outweighs it. That is disadvantage number one. And so what will happen is that the cost of debt, sorry, the WACC, WACC increases. What is this guy? What is this guy saying? What they're trying to tell you is that if a company has debt in its capital structure and they borrow for that money, what will happen is that the time will come when the bank that is lending them money will increase their rate just to discourage them from borrowing further. And at that moment, the WACC that is going down will increase. That is what they're saying, because the fact that WACC is lesser than the cost of equity is because there is tax savings and then the cost of debt is constant. But the moment a time will come when that if care is not taken, it will start rising back. And let's look at it in this small diagram. So they are saying that the traditional people who are useless people are saying that you see this and this. So now let me bring you the headache, and I don't have choice to teach you the headache too. So look at this guy. They're saying that, okay, look at this. You still understand what I'm about to my combination now. You will love this. So Sam. And then this one no bend like banana. Where this is cost of equity, this is WACC, and this is cost of debt, this is gearing. And then underneath it, there's another graph, which is called value of the company, market value. So we call this one market. And then we say there is optimal listing, that the value of the company will be going up, going up, going up. A time will come when it will reach the maximum level and it starts dropping. We call this one the value of the company. Now, that means the point at which this guy is at minimum, the cost of debt, sorry, the work is at minimum. Let me make it make sense. So the point at which the work is at minimum is at when the company value is at maximum. And this is called optimal capital structure. Optimal capital structure. Don't forget that what we use work to do, we use work to discount to find present value of a of something. We use to find present value of something. So the higher the work, the lower the present value. The lower the work, the higher the present value. So if the work is lower, it means that the value will be high. So the point at which the work is lower, the company will be higher. Now, what is making the work, the company value dropping? Because look at this. The moment we have cost of debt, the cost of debt is falling, all right, due to tax savings, the work is falling too. And the company value is rising as the work is falling. But when it got to this minimum point, the cost of debt, this time there is a benefit at this point. All right. But at this point, there is a cost, it's not benefit again, it's a disadvantage. Because the moment cost of debt begins to rise up, the work also rises. And what happens
Sorry,
to the company value? The company value keeps falling. Yes.
sorry, sir. This traditional theory, is it still under word of no tax or word of tax?
We have left Modiglani and Miller with their words. It was
Okay.
after they propounded their useless word of no tax that traditional people now came up and say, we have seen the thieves. Now we have another theory that will settle matter. So they came with this nonsense too. Do you understand? Just for all of you to have a dick. Are you with
Okay.
me?
Okay, sir.
Yes. So now they came with their own words that okay, there is tax. They recognize tax actually, right? They recognize tax because they say that the cost of debt, of course, will give us tax savings, and that is why the cost of debt will be falling at some point. But the time will come when
Hello,
that
sir.
the hello, yes.
You said when work is high, what happens? And then when work is low.
I'm coming there, man. So they are saying that when the cost of debt is falling, right? When the cost of debt is falling, the company value will be rising, and then the work will be falling too, because it is the cost of debt that is obsessing the cost of equity not to rise. So, but when it gets to a minimum level, an optimal level, that means the minimum. So because optimal can either be minimum or maximum. So when you get to optimal level, it means that the cost, and we keep increasing our debt. A time will come when we'll be paying more money to service the debt. And at this point of time, the cost of debt will start rising. It will start rising. And when it starts rising, the work too will be rising. And don't forget, it's because that is work is falling that the company value is rising. The moment work gets to the minimum, the company value gets to the maximum. So when work begins to rise, because we used to discount the company value, the company begins to fall. So they are saying that there is an optimal level of gearing, that the benefit, the cost will outweigh its benefit. And so at this point, we should stop borrowing money. Are we together, class? So they're saying at this point where the cost is outweighing the benefit, we should stop borrowing. It means that the gearing has gotten to its optimal level. And so gearing is very relevant to a company's value. Are we together in this weather class? Yee. Are we together?
We are together.
Okay. Let me increase the volume. Let me increase the volume.
We are
Now,
together. We are together.
no problem, no problem. So does anybody have question?
We got a day.
Hmm. Are we with anybody? Does anybody have question, please? Okay, since there's no question, so here is an argument between M&M and traditional model. M&M now looked at what traditional model did and said, "Abba, now I think it's a book. What you have expressed here is disequilibrium market, because in a market where demand and supply adjust themselves,
Sorry to
they will
interrupt you. Sorry,
okay.
sorry. You said the time we keep paying to increase our debts, then you didn't complete the statements.
What
Didn't
did you say?
understand.
Sorry.
You said that the time we keep using to increase our debts. I didn't get that statement. I think it was incomplete or something.
I said when we increase our debt, we
You
will
said
increase
that.
borrowing money. The work begin to rise. Is you can see it on the graph. And when the work rises, the company value begin to fall. Do you understand?
What was even saying? Safe. It's different from what I'm saying.
What are you saying? Abi, is you that know what you are saying? What are you saying?
Wait,
Yagogo.
wait. You said if the work is lower, the value of the company will be higher, right?
When yes, yes.
And vice versa, right?
Uh,
So you were not saying that the time that we're using to like the time we're using to when we're paying our debts, like to increase our debts, you were saying we are supposed to like pay some amount of money to increase our debt. Then you didn't complete the statement.
you didn't get me right, Mama. I said the more you increase your gearing, they assume that you will be spending more to service your debt, which will increase the cost of
Exactly.
debt. Do you get?
Okay.
So once it increases the cost of debt, it means the work also will increase. And once the work is increasing, the value of the company will be dropping.
Okay. I get you now.
Yes, you are welcome. So now let's look at now the M&M now responded because they don't have work. All of them are playing with your intelligence. That's why you have a problem today. M&M now responded to the traditional model. They respond. The Oga responded to traditional mode theory that you people are idiots. That if you are not idiots, don't you know that what you are propounding here is a disequilibrium market to stock market? It's a disequilibrium situation to stock market. And then it will represent it will this one will make investors to have opportunity to make arbitrage profits. All right. So and then it says that there is the market is determined by the forces of demand and supply, which will sort out arbitrage activities and it will restore equilibrium. All right. And so the need for equilibrium means that uh um we need to show that including tax relief, all right, would continuously reduce the cost of debt due to tax savings. All right. So, in as such, I mean, therefore, he's saying that in a world of tax, government subsidizes one form of finance, which is debt. Okay. He is saying that in the world of tax, in the world, in the world of tax, that was when they wake up, idiot people. In the world of tax, right? Government subsidizes subsidizes a form of capital, a form of finance, and that is what? Debt. And so they concluded that companies, they say, I think let me type it, that one is always faster. Companies, therefore, companies should use, right, as much as possible, much of subsidized, or let's just say of debt, which is a subsidized finance. That means companies should use as much as possible much of debt. So they are recognizing that Emma Jegbisi continue to get debt since it will give you tax savings. It doesn't go and borrow money from Lapo or Fair Money or cash. Or what are these app? So now let's look at this guy. They now came up with this nonsense again. Now let me write it out. M and M word of tax. You will love this. M and M world of tax. So they are saying that we can have okay. They also CB is the person that don't know how to draw graph. They to this a big graph. Now say okay, if your headache has not finished, though, we still gather the year that since the these people will not rest, which will not rest, and I mean you will not rest, that the cost of debt will keep falling. Cost of debt, in as much as you increase your gearing. Why? And then the work too will keep falling. The work too will keep falling. Work. KO. Or let me just write work. And then the cost of equity will keep going up. Cost of equity. Why? Because there is tax savings, tax relief. All right. On interest, we push work down. And then this one will go up. Why? Cost of equity will go up. Why? Because the increasing finance risk. My God, this is sweet. Because of the what? Increasing finance risk. So this is cost of capital, right? Origin. And then what happened to the value of the company? Since the work is reducing, it means that the company value will keep increasing. Useless people, right? So we'll prove it actually. Gearing market origin. Are we together, class? You can see now that both of the Modigliani and Miller and traditional model, they do get all of them, they do have sense. But whether they have sense or they don't have sense is not our problem. Our problem is that we should understand their basics. I'm just making it look funny so that we can understand what they're talking about. Actually, to some extent, they are relatable. And then to some extent, they may give you a headache. But then once you understand the concept, there's nothing like headache. So they are now saying that since we now believe there is what? Cost of there is a tax. So our cost of equity geared will be cost of equity on geared, right? Plus debt to equity ratio, plus cost of equity on geared minus cost of debt, 1 minus tax, right? Where the value of a company geared is value of ungeared plus VDT. And then the work also, the work of a geared company is work of ungeared 1 minus VDT over VG. All right, close the brackets. Are we together, class? Are we together in this weather?
Yes, sir.
Okay. I believe we are all enjoying the class. All right. Okay. Modi Salama Jakodumi. Okay. Will I be president today? And who else is enjoying the class now? Only 2 people. What's going on? Others, which happen? Adebanjo John.
Get
Adebanjo John.
as it be.
You know, get us. We never do anything. I've not increased the volume yet. So Victor. Shogbola Moise. Oyana. Laugh emoji delay yo. Modi Salama Jakodumi. She let you denumu. All right, no problem. We are live. Let's go. Let's go. Let's go. Let's go. Thank you. At the work. Show you Isha. Okay, let's go. Now, let me now say the work
Lonjo.
company equals to cost of equity on geared. Note this one. Note the work of ungeared company equals to cost of equity on geared, which means that when a company does not have debt, their work will be equal to their cost of equity. Oh my God, that is Rema. Rema. Okay, just save that. Just save that. Where the VDT now? The VDT, it means what? The present value of future tax savings on debt. So they are saying that the debt you bring into, they are still propagating their useless relevant theory that in as much as you can see basic, continue to take basic, it will not kill you if you keep increasing the value of your company. Because now, looking at this cost of equity. If you reduce your gearing, for instance, it means your cost of equity will reduce, right? The value of your company will reduce too, and then the WACC will increase, because it is because you increase your gearing that your WACC is reducing. They say once you reduce your gearing, WACC will go up, because the cost of equity that is high will now obsess the cost of debt. Are we together? And you will not save enough tax to reduce your WACC, right? So don't worry, we are going to prove it. We are going to prove it. Me, I like proving. Anything I say, I like to prove it, so that we'll all be happy at the end of the day. Are we together? Okay, so let's push further. We also have what about limitations of limitations of M&M theory? All right, M&M theory. Number one limitation is that they believe that it's better I type this one now, so that let me type. They believe that there are no one, there are no transaction costs in the arbitrage process. What that means is that uh, there is no cost in monitoring institution in the market. There is no cost in raising debt and equity also, and this is untrue. In real world, there are costs of monitoring market performance. So they also believe that there are no institutional factors against the arbitrage process. All right. So, and then it is not true, because many large institutional firms like insurance companies, right? So they will not wish to the um they will not wish to be prohibited from borrowing to run their business. They will not wish they are prohibited. So uh there is always a careful approach to market, and they also believe there is no taxation, or else it is neutral as between debt and equity. That one has to do with their what, with their first proposition. All right, financing. And then they also assume that personal they also believe that personal gearing carries precisely the same risk as corporate gearing, which is not true. They believe that personal gearing carries the same risk as corporate gearing, whereas the limited liability company, they enjoy means of the investor. All right. So they enjoy, rather they enjoy to borrow on the account of the company rather than on their personal account, because to a large extent there is a cheaper loan for companies, organization, and it is also easy for them. So the last thing is that they believe that personal borrowing is at the same rate of interest as corporate borrowing, which is not true. That the same rate that the individual borrows money is what company also borrow money. This is not true. It is always higher for individual and cheaper for companies to raise capital. So having said this, I would like to okay, this is 9:19. I would like to to test something, to go and practice something. But before we go to practice, there's another theory called pecking order. This one they pecking order theory. Pecking order theory. Pecking order theory. So what does the pecking order theory say? Right. So the pecking order theory says that there is always an order of preference to raise capital. That if you want to borrow, if you want to raise capital for your business, first consider internal one, which is retained earnings. If retained earnings is not enough, go to straight debt, which is bond. which is bond. And then it says, if that one is not enough, go for convertible share, convertible debt. If that is not enough, go for preference shares. And the last resort is what? Equity shares. So that is their order, pecking order. Why they say that is because they believe that number one, the reason behind the pecking order assumption is that reasons, one is that they believe that it is easier to use retained earnings than to go to the trouble of obtaining external. eh, So number two, they believe that there are no issue costs if retained earnings are used, and that issue cost of debt is cheaper than equity. And also they believe that investors prefer safer securities, right? That is debt um with its on income. And then some managers believe that debt issues have a better signaling effect than equity. Now, what does that mean by signaling effect? That means the signal to the stock market. That's what it means. That debt has better signaling effect. All right. So, but then there are consequences to their theory. There is a limitation to their theory because it fails to take into account taxation, financial distress, right? Agency costs, and now investment opportunities that are available may influence the choice of finance. All right. And then another limitation they have is that it is the pecking order theory is an explanation of what business actually does, what a business does, right? Rather than what they should do. All right. So it is premised on what businesses are doing rather than what they should do. Okay. So let's now look at factors that determine capital structure. Factors, because in as much as we are doing theory calculations, I wouldn't want our theoretical class to suffer, so that you will not be carried away with theory and then you leave calculations. That will be a disaster. So let's look at factors that determine capital structure. Number one, excuse me. Number one is restrictions in loan agreement. Restrictions in loan agreement. So when there is a restriction on loan, of course, companies may go for equity. All right. So they will go for equity, right? So that is number one. Number two, asset structure. All right. Asset structure.
Sorry. The reasons under the reason you said some managers believe that debt issues have a better signal effect than the statement is not complete.
Than equity, sorry.
Okay.
Okay, so now factors that determine capital structure, we have restrictions on loan and then asset structure. So when we say asset structure, some banks, organizations that will lend out money to companies, they prefer them to have a tangible asset rather than intangible one, the one that they can secure their money on. So if this is not in place, of course, they may not be able to raise debt. So another one is what? Operating leverage. All right. So the operating leverage looks at their uh um they want to look at, okay, how often, what is your current level of finance risk? Should we reduce debt so as to have, I mean, should we so should we reduce debt so as to reduce our finance costs? So very essential. So there also another factor is growth rate. Are we good? Are we good, class? So any company that wants to expand quickly will rely on external capital. External capital, because external capital, um, like equity, they exceed the ones that you can generate internally most time, and that's where you can generate much funds quickly. So they also, another factor is tax. So tax is that we want to choose which one we release will be subsidized. Tax, I mean debt, for instance, we can deduct interest expense, so we will enjoy some tax savings. But equity, we cannot have any tax savings. Let me give one more, and that is cash flow ability to service debts. Cash flow ability to service debts. So they want to look at, okay, what is our cash flow? Is our cash flow that healthy so that when we borrow money, we'll be able to pay for it? So that is that on, you know, factors that determine capital structure. Okay, on that note, let us go and check a question and see where we can stop tonight. Because after the whole theory, we need practical so that we can understand what SFM is saying.
Value of debt, 2 million naira.
Okay,
Value of equity, 300 million.
give the
Total value
figure.
of the okay. Total value of the company, existing cost of debt before tax, existing cost of equity, tax rates. The company proposed million naira of new equity to use the money raised to repay 2 million naira of the company, which can be assumed to be underdated. Assuming all earnings are distributed as either interest or dividend. Required: A. Calculate the existing. Sir, please, body. Okay. WACC. 2. EBTI. Return required by the ordinary shares to the compensate for the business risk only. B. After the changing in capital structure, calculate 1. The company total market value. 2. The stakeholder weight. 3. The company work. And 4. The company cost of equity.
Okay, we have value of debt equity, value of the company, existing cost of debt before tax, existing cost of equity, tax rate. And the company proposes to raise 25 million of new equity to use the money raised to repay 25 million of company's debt, which can be assumed to be undated. All right. Assuming all earnings are distributed either as interest or dividend, that means PAT in this case equals dividend. That's what it's telling you. All right. So, and then I will try as much as possible to send you theoretical, explanation, because at this level, I don't expect them to test you something very critical on this topic, right? But then I just have to let you understand that the ones I've explained are relevant. They might bring question from anywhere here, just to test your knowledge and see what you know that when you're talking about optimal capital structure, you're talking about what traditional model, right? And then it has advantages and disadvantages, which we highlighted here. And then the Modigliani Miller proposition 2, word of tax proposition 2, all right, is what talks about the the fact that we keep increasing gearing, and then the value of the company keeps increasing. Okay, so and then the value of gearing is not relevant to company's value, because there will be always tax savings, and then it is good to keep increasing money, I mean debt, magic law. And then which means that in the world of tax, government subsidizes the form of finance, which is debt. Therefore, companies should use as much as possible of debt. So that is what they're saying. All right. So let me say that you guys have been doing so well, but in this case, please follow me carefully so that we can round off on time. So the question says that we should compute one, existing WACC. Don't forget in this question, they gave us the value of debt, equity, value of the company, the cost of debt, cost of equity, tax rate. And now said the company is trying to raise 25 million naira of equity, and they want to use this money to repay 25 million naira of what debt. What they want to do is that number two, they want to achieve two things or three things. Number one is that they want to reduce their gearing, their debt equity ratio, because the equity will not be more than debt, number one. And number two, they want to reduce their finance risk, because the more you reduce gearing, the more you reduce your finance risk. Are we together, class? Yes. And they also may embark on that so that they can have access to further cheap loan in the future, because they know that the more debt they have in the capital structure, the more it may be difficult for them to raise money in the stock market, because before you invest in a company, you're going to check that debt equity ratio. If it is too high, you know that your dividend is at stake, because they want to pay their debt first, unlike of you. So calculate what existing EBIT. EBIT can be calculated when we work backward. EBIT, because there's no revenue in this question, obviously. So, but when we say EBIT with less interest, all right, and when with less interest, we're going to have profit before tax. When with less tax, of course, we're going to have profit after tax. So if we can get profit after tax, we can actually work backward to get EBIT. So let's check the question, class. I'm trying to make this thing relatable, so that if you are caught up with this kind of question in the exam, this is how you think as well. So, ladies and gentlemen, existing means that before they change the capital structure, so we don't have any business with the reduced debt by 25 million naira. Okay, so don't forget, they said that the all earnings are distributed as either interest or dividend. That means all earnings are paid as dividends. So if you have profit after tax, we can also if you have dividend, we can have profit after tax. So can we have dividend in this question? All right, don't forget that dividend, all right, is market value over number of ordinary shares. Sorry, what am I saying? No vex, no vex, no vex, no vex. So yes, sorry, if we are looking for market value, for instance, market value, we say dividend per share over, okay, we say dividend, let's know, since we're using market value, let's just use dividend over cost of equity will give us market value. So if we're not looking for market value, what we do is that we cross multiply. So dividend becomes market value times cost of equity. So the market value here is 300, all right, times cost of equity, which is 20%. So that gives us 60 million. So since dividend equals PAT, all right, so this is 60 million, all right. So now 60 million tax. How do you know the tax rate? They said tax is 40%. 40%, okay. Since tax is 40%, which means PAT will be 60% in here then. So that means this CBT will be what? PBT will be what? 100%. Are we together? So in this case, I will use mathematics to get my answer. I will say if 60%, 0.6, if 0.6, now I want to calculate PAT. If 0.6 equals to 60 million, the what will now be 1.0, which is 100%. All right. When I cross multiply, X will be 60 divided by 0.6, and that gives me 100. So my profit before tax is 100 million naira. So what did I move from 100 to get 60? That's 100 minus 60. This is what? 40. The tax rate is 40. So what about interest? Interest is calculated as cost of debt times the value of debt, just like we calculate dividend as market value times cost of equity. So value of debt times what? Cost of debt to is interest, and that is 200,000 times 12.5%, and that gives us 25 million naira. All right, so 25 million naira. Okay, so this is 25 million. All right, so since what did we deduct? Don't forget we are lessening it. That means we added to this guy to get what? 125 million. So our EBIT is 125 million naira. Now, this process may be long, but is there any other way we can go about it? Yes. So what is the way? We can say, so we calculate, okay, I left work to calculate EBIT. No vessel. Okay, if we say we want to use another shortcut, I can say EBIT EBIT, correct? EBIT. Since WACC can be seen as EBIT 1 minus T over EBIT 1 minus T over WACC. So this can be seen as company value. Company value. The value of the company can be seen as WACC. Now, how did I get this formula? Where did I get it from? You'll be wondering. Now, let me shock you that I can still break this formula down and say value of equity is dividend, all right, over cost of equity. Value of debt is interest 1 minus T over cost of debt, right? So now, if I now want to add these two together, right, these two, to put them inside this one, I will say value of equity plus value of debt will give me VG, all right? That means these two give me this one. Then the cost of debt plus cost of equity average gives me WACC. See this, you see, and that means the two denominator gives me WACC, all right? And then I will also say dividend plus interest 1 minus T gives me EBIT. Are we seeing the connection? Class, are we seeing the connection? Nobody talking. Kilasi, are we seeing the connection?
Yes, sir.
Yes.
You can see now I'm taking you through a very smooth journey.
Can you do from that this VG because if it's I don't understand that place from that place.
What they need. VG is value of a jet company, right? So which says that the EBIT 1 minus T equals to WACC will give me the value of a jet company. And I was saying that how did I get this value? Don't forget VG here, all right? VG here is a combination of the value of debt and the value of equity. Likewise, this EBIT is a combination of dividend, all right, plus interest 1 minus T. So that is this EBIT. And this WACC is a combination of cost of debt and cost of equity. Are you following me? So that is why I now separated them one by one. That means if I'm looking for WACC, I can use this one, these two. If I'm looking for value of equity, this is it. So that means these two, value of equity, value of debt, all of them transcend into this formula. That's what I'm trying to prove. And that was why I literally put it here that these two guys, they give me the value of equity. Their denominator, which is dividend and interest, give me a bit 1 minus T, all right, which I took to this denominator. And their denominator as well, the average of their denominator gave me what is called WACC. That is what I'm trying to prove. Are you following me now, please? Are you following me now, please?
Yes, sir.
Okay. Is that any to who is that? Okay, because I know that's it.
Yes, I see.
Okay, it's you. You don't come. Others, are we following? Please, don't follow him. Don't follow him. Enemy is great crashing, so don't mind him. He's SFM guy, so I don't want it to be oppressing you. I hope you guys are understanding me.
Yes, sir.
Beautiful.
Yes, sir.
That's my. I love that voice. Yes, sir. Okay, let's continue. Sorry. Okay, let's go. I didn't tell me. Okay, let's go, class. Shall not change my position like this. So we have okay, so if I were to use this formula, which is VG, all right, VG equals EBIT, all right, 1 minus T all over WACC. So do we have WACC in the question? Nah, we do not have WACC in the question, but can we calculate WACC? Yes. So let us compute WACC. WACC is, because the question even told us that we should compute current WACC. So now make no computer. So the WACC is cost of equity times value of equity. This would have been the WACC computation could have been requirement 1. Sorry. So let me just compute the WACC here and say
Sorry, sir.
yes, ma'am.
Please, what are we using the formula? This VG is equal to EBTI. What are we using it to calculate? Is it WACC?
What did you say, Mama?
I said the formula for VG is equal to EBIT 1 minus T. What are we using it all about WACC? What are we using it to calculate?
I want to use it as alternative way of calculating EBIT. Any formula that can give me EBIT, I will
Okay.
just make EBIT the subject of the formula. Are you following me, madam?
Okay, sir.
Ah, this man is
Yes,
a
thank
scholar.
you.
My God, this man is a scholar. Okay, let's go. So now we increase the volume now. So the cost of equity now is what? 20. Value of equity 300. All right, over 500. Right. But let me just write it out so that it won't cause another problem. Plus cost of debt 12.5. Value of debt, is 200. Right, and then 1 minus 0.4. All right, divided by what? 200 plus 300. So this will give me 15%. So this is actually the figure 1 in the requirement. So having said that, let us use it to compute our EBIT. All right. So if I insert that formula in EBIT, I'm going to have the value of the company is what? 500, right? And then the EBIT is unknown yet. All right, 1 minus 0.4 all over the WACC 0.15. So 0.15 times 500. So I'm going to have 0.6 EBIT equals 500 times 0.15. And that should give us what? EBIT equals 500 times 0.15. It gives us
75.
75 over 0.6. So EBIT is 125. So unlike working backward here, I can just use this formula to get within 4 steps to get my EBIT. So anyone you are comfortable using, you are free to enjoy yourself. Just enjoy yourself. Don't take life hard. All right. So let's push that out and then go to the Roman figure 3. They said calculate existing work. We've done that. EBIT, we've done that. The return required by ordinary share capital to compensate them for what? For business risk only. Oh, so to compensate them for business risk only. Business risk can be gotten in 2 ways: from gearing, Peter of assets, and from the Galani Amila, cost of equity on geared. All right. So in this case, beta of asset and cost of equity on geared, I'm looking at okay, fine. And do we have beta in this question? No. But if we have beta, I can actually use beta to get it. And mind you, note, let me give you note. Beta and Modiglan M&M approach let me use it this way. Capping using beta and M&M approach would give the same cost of equity once risk-free rate and cost of debt are the same. Compensation, Roman figure 3, compensation for business risk only. Don't forget, when I was giving you cost of equity on get, cost of equity get, I said cost of equity on get plus debt over equity, excuse me, cost of equity on get minus cost of debt, 1 minus T. And I told you that this is what? Compensation compensation for finance risk. Don't forget, and I said this one is compensation for business risk. So if the question now says that, the question says that calculate the existing WACC, EBIT, and 3, return required by the ordinary shares to compensate them for business risk only. That means they want you to compute just this. This is what they want you to compute. Are we together, class? So that's why you must understand the formula. Now, had it been they give me beta in that question, I can think they want me to use beta. But since there is no beta in that question, which I know that the beta is also what? Business risk. So since there's no beta, it means that I have to use what? Modigliani and Miller. Because you can only get business risk in two, either from beta or from M and M. So the question did not tell me to use M and M approach. But the moment I saw to compensate them for business risk only, my mind went to business beta of assets, which I know is business risk. But I also know that in M and M formula, there's something called cost of equity on geared. Ladies and gentlemen, to go further to solve the question, what we just need to do is to say cost of equity geared is 20%. Cost of equity on geared, I don't know. Debt 200, equity 300. Open bracket, x minus cost of debt 12.5, 1 minus 0.4. Are we together, class? So if I expand this, I'm going to be having okay. So I'm going to be having 20 equals x plus 0.4x times 2.5 times 5 minus 5. So if I transfer this guy there, we're going to have 25 equals 1.4x divided by 1.4, 1.4. X will give me 25 divided by 1.4, 17.86, 17.86%. That is the what? Cost of equity on geared, which is business risk compensation. All right. Compensation for business what risk. It's as simple as that, my friend, my ladies and my friends, my brethren, my scholars. So we're done with A. Now B says after the change in capital structure, calculate one the company total the company's total market value. Here we need to ungear and regear using what? Modigliani and Miller. How does it ungear? Because anytime there's a change in the capital structure, there's need to first of all, now the first step, anytime there is a change in capital structure or tax, when we get to a professional, we're going to look further. How tax can happen, this can happen, but at this level, I will not finger our brain unnecessarily, okay? So in capital structure, anytime there's a change in capital structure or tax, there is need to calculate. Let me just limit it to capital structure for now so that I won't give you unnecessary stress. So there is need to calculate first value of ungeared the value of ungeared company using old information. Number 2, calculate the value of the value of a geared company using new information. Now you can see that this process talks about gearing and ungearing. Because the value of ungearing means I want to remove debt, you ungear it with old information. And if it was beta, we use with, we ungear it with a proxy, and we now regear it with the new finance. All right, so let's go. So the value of a jade company, and okay, the question here, which is part B, part BI, is to calculate. They said after the change in capital structure. All right, calculate one I, the market value of Rogas. All right, sweet. Okay, to calculate the market value of Rogas, what do? We say the value of the jet company, right? VU plus VDT. We follow this step. So the first thing is to calculate the value of jet. So the value of jet is the 500,000 is the value of the company. Value of our jet, we don't know. Plus value of debt, old one, 200, 1 minus T, minus 0.5. So we'll calculate this guy, 0.6 times 200 will give me 80, right? So this is x equals to 120. Oh, sorry, VDT. Now just say they follow me, I mean, I don't sleep. This is 0.4 now. So this is x equals to 500 minus 80, and that is 420. So since x is 420, that's first step. The second step is now to calculate the value of unjet using, so calculate new value with new structure. So what I'm going to do is now to say the value of jet is 420 now. Plus, now note that what has happened to the company finance is that it has gone from balance sheet now, has gone from initially we have debt, sorry, equity was 300, right? Debt was 200. Now equity, we have raised 25 million equity to make it 325, and then we use that money to reduce debt. We pay 25 million to bank straight up, so it will lead to 175, right? So to you now it is still 500,000, but that to us is not 500,000 anymore, but we'll prove it. Now that means the new debt is now 175 million, right? So, and then the tax still remains. So what I'm going to have here is what? 490. So the value of the company has reduced by 10. Can somebody tell me what just happened? This cost of equity is compensation for business risk. This guy is for compensation of finance risk. And both of them make what? Cost of equity geared. And if cost of equity geared is 20%, and cost of equity on geared is 19.8, sorry, 70.86, 70.86 plus compensation of finance risk X. So to get compensation of finance risk, just say 20 minus 17.86, I get 2.14. Lastly, I hope you follow me. You see how I evaluate you now. Tap tap. I know who is following. They could follow me very well. Oh. Don't just follow the ladder. Oh. Follow the ladder. Oh. Brother, follow. Okay, let's go. That's good. That's good. Okay, so let me push. All right, so we've calculated the value of the company, which is we got 490 million naira, right? 490 million naira. So that is the value of the company, the value of the company, the value of the company. So let's go. This is the value of the company, right? So we've answered BI. Next one is BII. So the BII says that the shareholders' wealth, the shareholders' wealth, shareholders' wealth, shareholders' wealth is talking about the value of equity. All right, the value of equity. Now, to you, the value of equity has gone to 325 million because existing what? Existing value of the equity was 300. Now, additions, right? There is an additional issue of 25, which gives us 325. All right. But don't forget that um, the new value now, the new value, because this is, let me clarify that this is the value of equity. All right. But it is not the wealth. The wealth has reduced. How? Now, I will prove it to you. If you take this value very well, something has happened here. This 490, right? This 490 is the value of the company. If the value of the company is 490 and it is divided into two, which is equity and debt. So if debt is 175, 490 minus 175 will give us 315. 315. So which means that the new value is 315. All right. So there is a loss of wealth, loss of wealth of 10 million naira. Okay. There's a loss of wealth of 10 million naira for who? Shareholders. All right. So that is exactly what they want us to bring out. So they've lost their equity by 10 million naira. Ladies and gentlemen, they said companies work. Let's calculate the company's work and the cost of equity. They will call it a night. Okay. So please and please, like I said, the company work is a BIII. Okay. So the work is the work of geared equals to work of ungeared 1 minus VDT over VG. All right. And don't forget, I told you that the work of ungeared equals the cost of equity ungeared. So we may not need to go and calculate work of ungeared again because it's still the process. You first to calculate the ungeared using old information, you calculate the work of geared using new information. And here we have calculated the cost of equity here to be 17 point, cost of equity ungeared to be what? 17.86. But for simplicity's sake, let us prove it. Let us prove it. So the work of geared is what? 15% equals X work of ungeared, we don't know. Work of ungeared, we don't know. So 1 minus VDT, 200 into bracket 0.4, right? Divided by 500 using old information. Don't forget old information. So what we do now is that we say, border follow the ladder. Divided by 500, right? Minus 1. So that gives 0.84. So we have a back of ungeared 0.84 equals 15. So 0.84, 0.84, which gives us 17.86. So you can confirm the figure. They will give us the same thing. All right. So now let's go that the work of gate company now. All right. So we be back of on get 17.86 into bracket 1 minus new value now 175 0.4 all over 490. Okay, so and that gives us so don't forget I said once we reduce our gearing, the work will increase. It may be significant or marginal, but it will increase. So 175 times 0.4 divided by 490, right? Minus 1 times 17.86. That is 15.31%. 15.31%. Now let me take you back. our existing WACC was computed, our existing WACC was computed as, let's check the WACC. Our existing WACC was computed as 15%, was computed as 15%. But now that we reduce the gearing, the WACC has increased a bit by 0.31%. And that was when what I said when I was explaining here that once we, according to Modigliani and Miller, it says that once we, okay, I know we are defined. Once we, look at this, I gave it here that it says that once we reduce the gearing, the WACC, the cost of equity will reduce marginally, the WACC will increase. The WACC will increase, right? And then the market value will drop. The market value has dropped from, the value of the company has dropped from 500 to 490 because we reduce gearing according to their theory. Now the WACC, the VG has increased. Let me go and summarize. Let me just say this thing that once, how do I put it? According to them, once gearing reduces, cost of equity, right? Let me use a symbol so that the class will be sweet for everybody and all of us will laugh together. Even if you're not laughing with me, I'm laughing with you. So if gearing is reduced, right, the cost of equity geared reward we increase, we reduce, because it is because we are increasing the gain that we compensate them more, right? And then the WACC, what happened to WACC? The WACC will increase, all right? And then what happened to company value? The company value will drop because we save lesser tax. And if I take you back to that computation, you will see that in this company value, when the debt was still 200,000, when the debt was 200,000, we are saving 80 million tax. Don't forget, we call this one the present value of future tax savings, this 80 million. But when the debt has reduced to 175, when you multiply this one with this one, you will see that it's going to be what? 70 million. So the tax savings has reduced, and that is what reduced the value of the company. Are we all following me, class? Class, are we following me?
Yes, sir.
Yes, sir. Following.
Uh-huh. So when the gearing increases, according to Modigliani and Miller, so they say that the cost of equity will increase, all right? The WACC will keep falling because of increase in tax savings, and the value of the company will go up because we save more tax. The value of the company will go up, right? So these two, make sure you do not forget. All right, so let's push further. Now, let us go and check. The shareholder has lost some value of 10 million naira, right? So, and the WACC has increased marginally, right? So let us check the last one, which is company's cost of equity. Let's check if the cost of equity will fall, as we said. So the cost of equity geared is cost of equity on geared, right? Plus debt over equity, cost of equity on geared minus cost of debt, 1 minus T. Ladies and gentlemen, if we have not computed cost of equity before, we still do on gearing. That means we calculate cost of equity using old value. We now calculate cost of equity geared using new value. All right. But since we have done that one before, so all we just need to do is to calculate the new value straight up. Is 17.86 plus debt 175, equity 315, right? Into brackets, cost of equity 17.86 minus cost of debt 12.5, right? 1 minus 0.4. The button. So let's check. Oshubarere, 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 times 0.6, right? Times 175 divided by 315 plus 17.86. Now, Now it must fall. There is an error here. Let me calculate again. So 175 divided by 1 divided by 315 times 0. So no. 17.86 minus 12.5 times 0.6, right? Times 175 divided by 315. Plus 17.86. It must fall now. 19.65%. You see now, you see that when you understand something, even if we make mistake, you can trace back, say this figure I write in error. Are we together? That's why you must understand FM. Now, please, I want to urge you, ladies and gentlemen, go and practice this thing again and again. I would not have other issues here. I will just stop it here. Hopefully, would not go beyond this level, even if they want to make it complex. Not for you at this level. They may test more of theoretical aspect of this, and I'm going to send you questions and answers on that. But practice this one, even in the question and answer, I will put a calculation there that will be soft. Do you have any question for Genius class?